So this video is all about other influences on financial management, and we're going to have a specific focus on the influence of the government. Now, we will focus more on the Australian government and the influence it has, but it's important to note that every country and every government of each economy will have different policies, but they all sort of fall under the same sort of two general characteristics as highlighted in the syllabus here, which is company tax and the Australian Securities and Investment Commission, and each country will have its own version of that. So firstly, we're going to start off with the Australian Securities and Investment Commission, which is also known as ASIC. Essentially, this whole organisation was developed in 2001, and it pretty much regulates corporations and markets that are all within the financial services industry, and it regulates them based on the Corporations Act of 2001. So it pretty much is the enforcer of that law, and its role is to then supervise the financial market to make sure that businesses are being honest, they're being fair, and they're being very efficient. They're not committing fraud, and they're not committing any sort of unfair practices in the financial market. And ASIC is in charge of performing different market assessments, questioning reports, and they look at different activities like insider trading to make sure that the financial services industry is a very fair place. So how does this actually impact on financial management? Well, it does this in three ways. Firstly, if and only if you are listed on the Australian Stock Exchange, in other words, you sell shares publicly, only if you do that, you have to submit a prospectus. And a prospectus is a document that includes all the financial reports, all the information about your businesses, things that investors will need to know. But in order to create a document like this, it's quite timely and it's very costly. You're going to have a whole team to create an accurate prospectus. And it also needs to be audited. And audited just means, and I'll write this word here so you know, audited just means it needs to be checked over by either an internal but usually an external party, and they go through all your financial statements and all the information that you are putting in your prospectus and making sure that it is accurate. So if you have to list on the ASX, the Australian Securities and Investment Commission makes you submit a prospectus. Second of all, if you do commit any sort of misconduct, the Australian Securities and Investment Commission will make this information available to the public through the media. And the big issue with that is it leads to negative publicity. Now, negative publicity is really bad for your business. It can lead to reduced revenue and profits. It could mean that businesses won't want to invest in your company, and so it will be really hard for you to source funds. It has a whole range of implications. More seriously, there can also be financial penalties, and depending on the seriousness of the breach, there could also be potential imprisonment for people who were involved in the illegal practices. And that can lead to a lot of money which is taken away from the profits of business, and obviously that has bad financial implications. So as a case study, we can look at NAB, which is one of the big four banks in Australia, and they are potentially looking at a multi-million-dollar fine for breaking the law more than 12,000 times. Essentially what they were doing is charging customers fees for no service. And this all came out of the Royal Commission that happened in 2019. They got released, the information. Essentially, it was the Australian Securities and Investment Commission that is filing the case against NAB. And because they've broken the law that many times, there could be a fine ranging from $250,000 to $2.1 million. So it depends on what the court finds. But it is the Australian Securities and Investment Commission that has done the investigation, and they're the one filing the case. So that's an example of how they can impact on a business. The second government influence on a business is company tax rates. Now, company tax rates change across the world, but as of 2019 and 2020, company tax rates in Australia were as follows. So first of all, small businesses paid 27.5% tax, and large businesses pay 30% tax. Now, this changed recently. So it used to just be 30% flat rate tax. The small business tax rate has been introduced recently, and I believe that there is also talks about including another sort of level of tax rate, but right now these are the two that you need to know. What characterizes you as a small business? It's if you have less than $10 million in turnover, and turnover is just how much money you're making, so sales that you have, not profit, sales. So it doesn't include your expenses being taken out of it. And companies pay this on their net profit, so that is your hard profit that you make after all the cost of goods sold and your expenses have been taken into account. So if we're looking about global tax rates around the world, we're just looking at regions here. Oceania, which is where Australia is a part of, is the highest in the world on average. And that top bar of 30% where Australia is actually some of the highest in the world. When you're looking at Europe, they have particularly low company tax rates, and this includes companies such as Ireland, which has about 12% company tax rate. And when you compare that to Australia's roughly 30%, that's significant. And that makes countries like Ireland more appealing to multinational companies and transnational companies to go there because they're going to pay lower tax. And often, as a result of different global tax rates, businesses do try to manipulate that, and we'll see that in a little bit. Now, income tax, and this is the tax on the profit that we're talking about, is not the only tax that companies pay. They also pay federal and state taxes such as payroll tax, capital gains tax, stamp duty, international taxes, but they are also tax collectors for the government in terms of GST. So the 10% extra that consumers pay on goods and services is paid to the business. Their job is to collect that, and then at the end of the financial year, they send that to the tax office as their role as a tax collector. What is the impact of this, though, on financial management? Well, firstly, businesses have to consider when they're planning, they need to understand the cost associated with running a business. So for example, if they're planning on buying a new factory, they need to consider the stamp duty tax that they'll have to pay as a result of that, which can be quite significant. It also means that they need to keep accurate financial records to ensure that they're paying the correct tax. If they don't do this, it could result in an audit of the business, and potentially they could pay fines for not paying the correct amount of taxes. And an auditing is a really lengthy process that the tax office does, where they go through every single financial statement, record, anything related to the financials of your business. And they go through it with a fine comb to make sure that they can calculate really how much tax you're meant to pay. Another big impact of company tax on a business is that companies need to be aware of potential tax deductions that they can claim, and they need to take advantage of tax incentives by the government, especially in Australia, because tax rates are so high. Any sort of advantage or deduction that they could do in order to reduce the tax that they pay will be highly beneficial on the financial objectives of a business. And so if we're looking at McDonald's, and McDonald's is really interesting because it is a multinational company. So it operates under many different tax systems. They pay tax in Australia, they pay tax in Singapore, they pay tax in America, they pay tax everywhere. On average, you can find in an annual report that globally, they said they paid around 2.4% tax on average. And that's significantly decreased from 39.4% in 2017. That was largely due to a significant reduction in company tax rates in America, and that is where McDonald's does pay most of its tax. They have been known, however, to use their corporate structure and the fact that they have lots of businesses in plenty of countries, and have been known to transfer money to different countries to avoid paying tax in Australia because it is particularly high compared to other countries. But as of 2017, they paid $137 million in tax on the profits that they earned in Australia.